We will have a copy of the presentation available to everyone who's registered after today's event in case there's something you missed, you just want to watch it again. So please feel free to look for that in the next day or so after we get finished up here. My name is Eva Bloom. I'm an education specialist at the Ohio University Credit Union. I'm going to be covering a lot of basic information about planning for retirement today. Hopefully, oh, it looks like do we have some trouble with sound? Okay, let me know in the chat if anybody looks like we have maybe one person who does not have sound, but it looks like the majority of us do. So please let us know if you're having trouble and we can try and get that resolved for you. Hopefully that you guys are all a little bit familiar with what the Ohio University Credit Union does. At OUCU, we are your not-for-profit financial institution, helping people with their day-to-day accounts, loans, reaching their financial goals. One thing you may not be aware of is in addition to helping you take care of that day-to-day financial responsibilities, we have a department that helps you plan for your upcoming financial goals as well. And a big one of those is your retirement, and that's our investment services division. So it looks like we still got some folks without sound, but most of us do have it. So I have had some success previously with folks who are having trouble maybe just exiting the meeting and trying to re-enter. That might be our first step to try and get that resolved. So if you don't have sound, why don't you give that a shot? And then also take a look at what speaker you're currently, okay, we've got one resolved, awesome. What speaker you're currently going through. Again, if you have any technical problems, go ahead and put that in the chat and we will do the best we can to get that resolved for you. So again, I'm Eva Bloom. I'm here as the education specialist. I'm going to be providing a lot of information about planning for retirement for today. We are very lucky to have two ladies with us on the call that have tons of information and can help us with all of the details that might come up for some of the material that we're covering today. I'm going to turn it over to them to introduce themselves. So Romney, if you want to go ahead and turn on your camera and say hello to everyone.
Hello, everyone. My name's Romney Garner, and I'm the Certified Financial Planner here on staff at Ohio University Credit Union. Basically, what that means is that I meet with credit union members every day of the week, and we talk about their financial goals, whether that is college planning or saving for a particular goal or saving for retirement, like we're going to talk about today. We may write an in-depth financial plan. We may just talk about rule of thumb planning. Some of the financial solutions that we offer through the credit union on the financial planning side are investments, IRAs within those investments. I generally tell people I'm the one that helps people with things that go up and down in the stock market, and how much you need to be saving to be able to get to retirement, which Eva will help you with today. But we're going to be available in the chat to answer any more technical questions that come up. And if anything is, really technical to your situation or your scenario, we're more than happy to schedule an appointment with you via phone, web conference, or in person at the credit union. We're located here at Schaefer Street on the financial services entrance, back where they do tax and accounting as well. So if you have something super technical that we don't want to put in the chat for privacy reasons or anything like that, we'll be available to schedule a meeting if anything arises that kind of starts making you think about things as Eva gives a presentation today.
Romney, a couple questions for you before we let Jeanette introduce herself. Do I have to be a credit union member to come talk to you?
You do not.
Great.
Nope.
And are you going to charge me if I just want to come and have a consultation?
Nope. You do not have to have there is no charge for a consultation. Essentially, we can, if you want us to do a written plan that's really in depth or something like that, we would negotiate if there's a fee going to be charged for that. But just to set up an appointment and have that conversation, absolutely not. And any fees in any of the investments are disclosed at that point in time when you make a decision. The other question that I get asked daily, so I'll just answer it before someone asks it, is, am I a fiduciary? And the answer to that is yes. As a certified financial planner, I voluntarily took on that role when I got that credential back in 2012. So it's a big thing out in kind of the news now, like ask your advisor if they're a fiduciary and working in your best interest. And absolutely, we are compensated by some of the things that we do sell, but we are required to not pay attention to that. When I'm making a recommendation is because I believe that it's documented in your best interest. And we also have a suitability team through our broker dealer that reviews all those transactions to make sure that's the case.
Great, thank you. And now we'll let Danette introduce herself here. Oh no, Danette, I don't think you have sound.
My name is Danette Carr, and I am the Financial Services Associate here at OUCU Financial Services, and I have been in this division for over 10 years, and so I've got a fair amount of wealth of experience as well to assist with clients, so I'm happy to be here.
Great. Well, thank you very much, ladies. These are very valuable resources that can help us today. Again, if you would put your questions in the chat, Romney and Danette will take those as they come. I will keep my eye on that chat as well. If there's something that I feel like is really important for us to discuss as a group, I can incorporate that into the presentation so that everyone gets the benefit of those questions as well. Awesome. We're all here to talk about retirement today, and I know that thinking about retirement brings up some mixed emotions for people. It's exciting to think about throwing out your alarm clock and having the days to yourself, but it's also a little scary because it can be such a big change. Whatever feelings retirement brings up for you, I am super glad that you joined us today because I think our discussion will help you clarify, first of all, what does retirement even mean and how can you prepare for that transition? Let's get started by thinking about what we are going to cover today. First of all, this is a disclosure that we're required to let you know. Romney covered some of this as well with, things can go up and down. Just letting you know that the investments that you may be involved in if you choose to take on any services aren't necessarily a credit union product. And I'm sure if you want to work with us, we can go over all of that in a little bit more detail. Just getting that out of the way here in the beginning. Our objectives today. I want to help you guys understand what you need to retire. I want you to consider the type of retirement you might want to have because that has a big role in understanding what you need and some of the scenarios that might affect the financial resources you'll need in retirement. I also want you to have a better idea of what you might have to retire. We're going to cover the pension, the alternative retirement plan, and a little bit on Social Security so that you can get an idea of how to figure out what you might have when you go to make that change. I also want to review some ways to maximize that retirement savings fund through tax advantage plans. And we're definitely going to cover how do you make a plan. What are some steps that you can take today, no matter where you are on your road to retirement? I know that sounds like a lot, so let's get started. First of all, what do I need to retire? The conventional wisdom here is that you need 60 to 90% of your current income in retirement. Now, that could be a very large amount of money in between that 60 to 90%. So how do you dial in and get a little bit better understanding of what you personally need for your situation? Well, it depends a lot on what you want your retirement lifestyle to look like. Are you going to be jet setting around the world, spending days on a tropical beach, drinking a cocktail out of a coconut? If you want to do a lot of traveling and live in a lifestyle that's very different than what you live today, more than likely you're going to be closer to that 90% or even above that 90% if you plan to be spending in a way that's very different than the way that you're spending now. Or do you maybe just want to spend a little bit more time with your family, with your grandkids, doing the things that you love? So this is the version of retirement that most people end up with, and they want to just do more of the things they want to do. If we want to figure out where we are on that 60 to 90% spectrum, start thinking about how is my retirement lifestyle going to be different than the lifestyle I'm living now? And then what does that mean for my day-to-day, monthly, or annual expenses? And that can help you get an idea of whether you're going to fall in that 60 or closer to that 90% of your current income. I bet Romney also talks to some people who fear that their retirement is going to look like this, meaning they won't get to have a retirement. They are just going to have to keep working. I know that this is a concern for a lot of people. The best thing to do if you are worried about this is to come and talk with a professional who can really help you assess your current situation and tell you whether this is something that you are going to have to take some more aggressive action on today so that you're not having to continue to work, or whether you really might be a little bit closer than you think. So that is something that we want to get ahead of, is this kind of fear about what retirement is going to look like and stressing out about how long we're going to have to work just because we don't have the information. So I'd encourage you to get the facts, get the details so that you're not needing to worry perhaps unnecessarily. If you are in a situation where you're not as prepared for retirement as you'd like to be, there's always time, if you're working, to start doing some savings. And those small changes can really add up. So if you are concerned about your retirement, that should be a great reason to schedule time to talk to either Romney or another financial advisor and really get some clarity on those questions so that you don't have to worry unnecessarily. So we're going to have a lot of control over the way we spend our money in retirement, but there are going to be some factors that are out of our control. And I want to go through those as well so that you're familiar with them. First of all, it's healthcare. Healthcare is getting more expensive every year. It's actually growing at a higher rate than most things in our general life that we have to pay for. So we need to understand the way that we're going to cover our healthcare expenses and how that might impact our spending in retirement. So even though this is something that we might not have control over, there are ways that we can prepare for this. There are ways that we can prepare for all of the risks to our retirement spending. And that is to create a plan, create a spending plan for what you feel like you're going to have in retirement. Start trying that out before you get to retirement so that you have an idea of what it is. And to also create yourself a retirement emergency fund. And that's something that you can do through supplemental retirement accounts, which we'll talk about in just a bit. So healthcare, although we may not have complete control over these expenses, if we're prepared for how they might change and we understand how we might cover them, we can feel more comfortable with what our retirement is going to look like. The healthcare increases have been about 20% over the last decade. No one that I've talked to really expects healthcare to become less expensive in the next 5 or 10 years. So that's something we just want to incorporate in our plan and understand that we're going to have a way to cover that when we get to retirement. Additionally, a great factor is that people are living longer. That does cause some people to have concerns about will they outlive their money. I'm sure that's something that Romney has talked to her clients about, and something that we want to be assured that we're going to be able to live and enjoy our life in retirement the way that we want to. So if I'm 65 years old today and I'm in a couple, there's a 40% chance that either one or both of us are going to live until age 95. So if we are planning to retire in our 60s, it's good to plan for about 30 to 35 years in retirement. And that takes some understanding of how we're going to continue to fund our lifestyle over that time frame. It's going to look differently if you're in the pension system than if you're in the alternative retirement plan, but we want to have an idea of how we're going to continue to support our lifestyle through all the years of our retirement. The last thing we want to be aware of is the way that stock market changes might impact our retirement income. So the stock market can go up and can go down. What do we have exposed to the stock market in retirement? What do we need to continue to earn on our investments in retirement? Is something that you'll probably want to talk to a professional about because these can get kind of complicated, but something that we want to understand so that we feel more comfortable making that transition into retirement and knowing where we are. Also, people have been talking a lot more about inflation recently, and this is a concern that folks might have as they move into a situation where they're living on a fixed income. How are the changes to inflation going to affect your ability to maintain the lifestyle that you want to live? So this is great stuff to have a conversation with a professional about, because this is the stuff that they do every day. So now we have a little bit better idea of maybe what we want our retirement to look like, and what are some factors that we need to understand before we get to retirement so that we can plan for those and be comfortable. Now that we have a little bit better idea of those items, let's dig into what you might have to retire. So we probably have people in the audience today that are both part of the alternative retirement plan and the state pension plan. We also probably have people in our audience who may have paid into Social Security for a number of years. So it's important that we understand how the Ohio retirement programs interact with that Social Security system. Let's take a look at the options that you have as Ohio University employees first. So you have either selected the alternative retirement plan or the state pension system. This is a decision that you made within the first 120 days of your employment. So you've made this decision, and now what does that mean for your retirement income? If you're a part of the Ohio Public Employees Retirement System or the State Teachers Retirement System, the amount of money that you'll have to live in retirement will be dependent on a few factors. First of all, your years of service, your age when you retire, and your final average salary. In order to get an idea of how much you personally will have when you retire, it's a good idea to go on to the pension system's website. They have a lot of information for you to help you get an idea of what you'll have when you get to that retirement age. So I would encourage you to check those out. There are a lot of great tools for you there. I think we might have gone over I apologize. Seems like I am missing my slide for the alternative retirement plan, so I'm going to take just a moment to talk about that here. So for the alternative retirement plan, you are going to have your income determined similarly to the way that an individual in a 401k would have. The way that you'll determine how much you have to retire is going to be based on how long you've saved, how you've allocated those savings. So in the alternative retirement plan, you have control over those investments. You can work with a financial advisor, you can do it on your own to determine what you want your money to be put into as part of that plan. The alternative retirement plan is great because it's portable. It's not connected to you being a public employee at Ohio University or anywhere in Ohio. And the money is yours from day one. So that's being fully vested from the day that you enter that system. You'll get your contributions and your employer's contributions. However, there is no guaranteed payout on the alternative retirement plan. So that's going to be very different than the pension, where you're going to get a guaranteed amount for the rest of your life. Again, the alternative retirement plan is going to be based on how long you've saved and where those investments have been allocated. And that is going to compare with the pension system, where you're going to have a guaranteed amount that's paid out on a monthly basis for the rest of your life based on your years of service, your age, and your final average salary. I hope that clarifies in broad strokes the way that you'll understand what you'll have for both of those systems when you go to retire. Now, let's talk a little bit about Social Security. The important thing for you to understand with Social Security is that as employees of Ohio University, you are not currently paying into the Social Security system. Although many of you may have had jobs prior to becoming Ohio University employees that did pay into the Social Security system. So we frequently find these two systems interacting with each other, and it's important to understand a little bit about Social Security and how it interacts with the Ohio University retirement plans. So first, basics for how will I determine what my benefit for Social Security will be. In order to receive a benefit from Social Security, you need to have a minimum of 40 credits. So let's unpack what this 40 credits means a little bit more. The 40 credits is actually relating to the amount you earn in a year rather than how long you have worked specifically as part of that year. So let's take a look at 40 credits. You need to have worked a minimum of 10 years in which all 4 credits were earned. That doesn't necessarily mean that you had to work that full calendar year. It means that you've earned the minimum amount to get those 4 credits for that year. So it's based on earnings, not necessarily working the full calendar year. How do I know whether I've gotten my 40 credits? How do I know what my qualified earnings are for Social Security? We recommend that you go to ssa.gov and take a look at your personal account. They have all of that information on there for you. Some of you may remember when they sent out the booklet. So we used to get like a booklet that would tell us what we had earned in the Social Security system. They've moved that online now. So I'd encourage you, if you haven't taken a look at that, to go ahead and log on to ssa.gov so that you can find out a little bit more of what you've got in that system right now. The calculation for your Social Security benefits are going to be based on your age at retirement. And then also, because you have time in the pension system or the alternative retirement plan, it's going to be based on some of the benefits that you're getting through your Ohio University retirement as well. So that relates to what's called the Windfall Elimination provision. The Windfall Elimination provision is set up to account for individuals who have had a job in a non-covered, that is not covered by Social Security. So in order to estimate this, you can go on to the Social Security Administration's website, and you can put in, some details that can help you clarify what the Windfall Elimination provision is going to mean for you. I have gone ahead and provided you, a little example. So I'm just going to take 1 minute here to review that, and then we'll get started back on track. Romney, I apologize here, guys. I'm just going to turn my camera off for just 1 minute. Romney, can you explain a little bit more about the Windfall Elimination provision for us?
Sure. So essentially what happens with the Windfall Elimination provision is if you have those 40 credits that Eva was telling you about, but you do not have at least 30 years of substantial earnings into the Social Security program, they can reduce your Social Security payment in retirement. So on this slide here, essentially what Eva's saying is that your Social Security statement, when you see it, when you go to ssa.gov and you register, it's going to say $1,000 per month at age 67, for example. That may be incorrect just because you see that on there, because Social Security does not know that you've put in 16 years through state teachers retirement at OU. So that is where we want to give you a heads up that you may be affected by the Windfall Elimination provision. And if you want to know, well, how many years of substantial earnings have I put in? When you get your Social Security statement and you download that PDF or they mail it to you, they used to mail it to you every 3 years. They may have stopped now, but you open it up on the inside cover of that first page. It'll tell you every year when you were working what your substantial earnings were, and what your earnings were. And then there, if you which we can send to you as well. But if you Google windfall elimination provision, it'll come right up on the Social Security's website. It's a 2-page PDF that tells you exactly for each year how much you had to earn in all those years for that to count as a year towards your credit towards having substantial earnings, so that your Social Security is not reduced by the windfall elimination provision. I will tell you that most people who worked in OU for quite some time will likely be affected unless you just put a ton of years into Social Security, or you had a job for many years where you were paying into Social Security and STRS OPERS at the same time with a substantial amount of earnings. So basically what you need to know is in your mind is, and that's something we'll help you with when we're getting close to retirement. I sit in on a lot of phone calls with Social Security when people were applying for retirement, and especially because we manage the alternative retirement plan, and that still is affected by the windfall elimination provision. It's because that technically is a pension, even though you're in your mind thinking, well, I saved in like a 401k with investments, but that does also affect the windfall elimination provision. So basically all you need to know for this meeting is what my Social Security statement says may not be accurate when I'm doing my planning based on how many years I've put in.
And I think we've found a lot of people have that question, like, well, what does this mean in hard numbers? And although I can't provide that for your own personal situation, we have found that individuals feel a little bit better just having an example. So we're going to go through an example for you just so that you can get an idea of what this looks like for, we're going to use just an individual here who kind of got the worst situation. So this individual that we're going to look at has 20 years in each system. So they've got 20 years in the pension system. They've got 20 years in Social Security. So what does it look like for them? So Romney talked about getting that Social Security statement, and it says, maybe it says your benefits $1,934. So this is a calculation that I put in based on some numbers that we created. If that's what my Social Security statement says, it's not factoring in the windfall elimination provision. So I went ahead and used that really handy calculator that's on ssa.gov to fill in what this individual would look like after the windfall elimination provision kicked in. And then we can see here on this slide that it actually reduces that individual's Social Security income from $1,934 to $1,477. So what this means is, if you are concerned about this, go on to that website and plug those numbers in so that you can get a little bit more data to figure out where you fall into this category. And then also, like Romney said, she's been on some calls with folks from Social Security, so we can talk through this situation with you as well if you're concerned. Just wanted to give you some numbers so it's not just kind of hanging out there as an unknown. I find that when people don't have the kind of hard numbers to go with some of these decisions, that's when it can get more stressful. So we do have a question that just came in here. Does an investment / IRA revenue through a private broker add to the amount of the windfall elimination provision? And the answer here is that it does not. So thank you very much for answering that for us, Romney. We'll go ahead and move on to our next one. I hope by now that we've got a little bit of an idea of what we want our retirement to look like, some factors that we need to understand relating to how much money that we'll have and where we'll need to spend that money. So let's take a look at another example. We're going to take a look at Norm L. Guy and his retirement savings and what retirement might look like for him. So Mr. Guy is going to retire at age 67. He is in the Ohio Public Employees Retirement System, and he wants to have a pretty normal retirement. He just wants to hang out more with his grandkids, likes to do bird watching in the backyard. He really wants to be able to take one trip a year with his family to make some memories. So when Mr. Guy sits down and does his calculations, he thinks, I'm going to need about $35,000 a year to live the retirement lifestyle that I want. He took a look at his pension benefit and realized that that's going to provide him about $30,000 a year. We can tell here that he's not going to have quite enough money to live the retirement lifestyle that he wants. So he is going to have a shortfall of about $5,000 a year. So what is Mr. Guy going to do? Is he going to have to sacrifice that trip with his family every year? Well, if we do a little bit of planning, we can see how he can make up that shortfall. So over the period of time that he's going to be retired, including the ability that he can have his investments continuing to make, hopefully, we're assuming in this calculation, a 4% rate of return, he needs to have about $85,389 to make up this shortfall. So how can he do that? What are the ways that he can make up that amount of money? And that is where we're going to get into talking more about our supplemental retirement accounts. So these are tax-advantaged ways for you to save so that you can make your retirement lifestyle match up to your retirement income. So let's see what we have here. First of all, let's talk about the 403B and the 457. So these are our supplemental retirement accounts where you can put tax-deferred contributions and earnings. So these are similar to the 401k that a lot of individuals have in the private sector. This can reduce your current tax obligation. You can contribute up to $19,500 a year into these plans. If you're more than 50 years old, you can make some catch-up contributions and contribute an additional $6,500. In these plans, you can choose your own individual investments. However, the providers are determined by your employer. You can have those contributions deducted automatically from your payroll. Sometimes we get the question of what is the difference between the 403B and the 457. One of the main takeaways is that with the 457, you can withdraw those funds when you separate from your employer, even if that is before your official retirement age with no early withdrawal penalty. So that can be a major benefit for some individuals and why they may want to choose the 457 plan. We also have some IRA options. So this is going to be both the traditional and the Roth IRA are two supplemental retirement accounts that you can consider. For the traditional IRA, these contributions are going to be before taxes. So that can also reduce your current tax obligation. For a traditional IRA, you can contribute up to $6,000 with an additional $1,000 allowed for catch-up contributions. And you can choose your individual investments in these plans. You can also choose your own provider. So these are not related necessarily to your employer. You can choose who you want to have these accounts with. One of the main reasons we see people taking out the traditional IRA is to roll over 401ks from a previous employer. So we talked about individuals who may have previous employment and maybe they had a 401k, maybe they are paying into Social Security. When you reach retirement, it can be beneficial to have multiple retirement accounts consolidated into one because it can make it a little bit easier to manage. So one of the ways that people handle that consolidation is by taking their previous 401ks and consolidating them into a traditional IRA. Another option that you have as it relates to IRAs is the Roth IRA. So this is going to work differently than your traditional IRA because the contributions are going to be made after tax. So it's not necessarily going to provide you a tax benefit in the year that you're contributing. However, there are some special benefits that the IRA does provide to you. So again, your contributions into your Roth IRA are going to be up to $6,000 unless you are over 50, and then you'll have that additional $1,000 catch-up contribution. One of the benefits for your Roth IRA is that your withdrawals may be tax-free. So with the traditional, you're putting in your money pre-tax, and then you're paying taxes on that money when it comes back out of the account. With the Roth IRA, you're putting in your contributions once you've already paid taxes on them, with the benefit that those withdrawals may grow tax-free. That those contributions may grow tax-free, and then you can withdraw them without tax implications. Now, of course, you want to talk with either your tax planner or a financial professional for your individual tax situation. Again, with the IRA, you have the ability to choose your individual investments and your provider. So these don't have to be set up necessarily through your employer. So with these supplemental retirement accounts, they do offer some pretty big benefits, especially for those of us who are in the pension. So we talked a little bit about the pension and how that's going to be basically like a monthly paycheck that you're going to be getting in retirement. Some folks who opt for the pension find that they have some lump sum needs. So they might need a pot of money that they can draw on that's not going to be part of their monthly income. Maybe they have an unexpected expense or a larger expense that they want to handle. So that's where these supplemental retirement accounts can come in. They can provide you that kind of backup fund, pot of money, emergency fund that you can access in your retirement, and then also have the benefit of those tax advantages as you're saving. When we also talk about any retirement savings, it's important to understand that time is really our best friend here. So the longer I have my money in my retirement savings accounts, the longer I have the benefit of that compound interest. So that's where my interest can earn interest and I can continue for my money to grow. So specifically for those of us like me who have quite a bit of time before we get to retirement, I am going to do my best to save now so that my retirement savings can really have the benefit of that compound interest and grow. And then I'm going to be able to retire with more funds than I'd ever really be able to save just by the money that I'm able to take out of my income and put away. So that's really what we want to do if we can, if we're in that position, we have some time before retirement, if we can really prioritize that savings, we can put it to work for us. So I want to encourage you, if you're thinking, I don't really know what's the benefit of setting up one of these supplemental retirement accounts, is that we can get that kind of backup fund for ourselves, and we can also let the power of compound interest work for us. Now that we understand a little bit about the money that we'll have to retire, ways that we can add to our savings, let's talk about making a plan. First, we want to establish a timeline. 20, 10, 5, how long is it until you want to retire? It's important that you set out these details and really take a look at your overall plan before you get set on that date. So if you have a date in mind, but it's not really in your financial best interest, sometimes if we're just like, nope, I'm going to go this year, I don't really have the financial plan to back that up, we can end up making a decision that's not necessarily in our long run best interest. So start thinking about when you might want to retire, and then take a look at what the financial situation would be if you did retire in that timeline. Maybe it's better to work a little bit longer. Maybe you can retire at that date, but something you want to review. Also want to evaluate our current finances. So if we're not currently using a budget, or as I generally like to say, a spending plan, we want to take a look at that. We want to take a look at our income and our expenses. We have tons of information about a monthly budget. If that's something that you're interested in, I can provide those details so that you can get set up with some budgeting tools to help you get to that place where you're able to plan out your spending. We also want to evaluate our current debt. So a lot of individuals have questions about, should I pay down debt? Should I save for retirement? How do I balance these competing priorities? And this is where your financial advisor can really speak to your personal situation and help you create a plan that's going to allow you to tackle any debt that you have and still make smart investments for your retirement. We also want to think about financial goals. So we don't want this to be kind of a race to the end of work. We want to know, what do I want to do now? What do I want to do while I'm still working? Am I going to be buying a home? Do I need to prioritize saving for a down payment? Do I have kids that need to go to school? Do I want to just take a great trip? So understanding what my short, mid, and long-term goals are can help us create a plan that's going to work the best for us. We want to review what we have now. So again, our existing accounts. What do I think I might be getting from pension? What do I have saved in my alternative retirement plan? Do I have any other 401ks, IRAs, or other things that I can pull together so that I can get a full picture of what I've got? And then finally, you may want to talk to a professional. So retirement has a number of different factors. You need to take the income that you've got either from your savings or your pension and figure out how you're going to live on that. You also need to assess healthcare and what costs are going to be for you with your healthcare. And then what do you want to leave behind? Do you have any gifts that you plan to give? Are you going to be getting an inheritance that you can incorporate into your plan? Once you've gotten this plan together, you've maybe talked to your financial professional, it's important to take some action towards your goals. So if you want to set up a supplemental retirement account, you can complete your enrollment form, open your account with your provider, and then set up an automatic deposit for that savings to go directly into that account. We find that most people, when you don't see the money, you don't spend the money. We tend to spend what's in our paycheck or in our checking account. So if we can take that first step and make it a little bit easier for us to save, we can get that set up to go automatically. Once we've got our plan in place, it's not always a set it and forget it type of situation. We want to review this every 12 months just to make sure that we're still on track, that our priorities are still what they were when we laid them out 12 months ago. Or if you have any big life events, that's another great time to take a look at your plan and make sure that it still aligns with your goals and your priorities. So I hope that this has provided you some details for you to think about in relation to your retirement to help you start taking some steps towards where you want to be with this issue. As we talked about at the beginning, Romney does have availability to sit with you and kind of go through these situations, answer your questions. So we are more than happy to talk with you about this. We do have a little bit of time here to answer some questions from the group if we have any. And we've got one that came in. Do you assist businesses with setting up plan programs for employees and owners? And yes, she does. All right, so if we have any questions, please feel free to send them into the chat. Romney and Danette, I'll just ask if you have any questions or, I'm sorry, statements that you'd like to include. Okay, and then we've got a question from Andrew that I think might be important for the group. Does the Ohio Public Employees Retirement System pass to a spouse if the OU employee passes first? So Romney, would you take that for us?
Yeah, do you want me to answer it or type it?
Go ahead and answer. I think that would be important. And we've probably got a number of folks who are in the pension system and would like that information. Thank you.
Sure. So basically, when you retire, that will be a choice you need to make. And when you're in the traditional pension system, be it OPERS or STRS, a single life pension means that you're going to take the highest amount just for your life only. And then there will be other options where you can take the lowest amount where you leave 100% of that pension to your spouse if you were to pass away early. And then there's a couple combinations thereof in between. For example, 50% to your spouse or 75%. And that's a common question we get when people are getting close to retirement is what makes the most sense for us. And, you know, no one knows how long they're going to live. really. So that's, one of those questions that we ask, tell us about longevity in your family. What are your concerns for, do you err more on the conservative side of, I want to definitely protect my spouse, or no, they have their own pension system and they'll be okay. And we really just walk through what do those scenarios look like on either side of the fence if something were to happen to either one of you and you passed away early.
We have a question about combination of systems, but we also have one that came in that I think kind of relates to what you just said. So we're going to pop over to that, and then we will get back to the combination system. Romney, what happens if I pass away before I retire and I'm in the pension system? I believe that's the question. And if that's not your question, please go ahead and just let us know.
So if you're vested and you have enough years in the pension system, then it will say your survivor benefits that you are entitled to, or your spouse is entitled to, essentially, or your children or whomever you named as your beneficiary.
Okay, thank you. Let's hop up to our question. This individual has PERS, SERS, STRS, and OPERS. What happens when they go to retire?
It depends. Depends on how long you've been paying into it, how many credits you have. For that type of a technical question, I would defer to giving a phone call to those individual retirement plans and finding out how they will combine, or if they won't, based on your tenure and what class you're in, those types of things. Because it depends on, to some degree, whether you were mainly in one as opposed to the other and that type of thing.
Okay, thank you. So we've got a question. Can you talk about strategies for managing and mitigating tax implications when withdrawing retirement funds? So I will also say that we are not able to give tax advice in this format, but is there anything that we can provide on that question?
Yeah, so I'll just give you an example of essentially what we do here at the credit union. I'm not a tax advisor, but we have a tax team back here, and we work closely with them where we have them run what we call tax planners when you're a tax client back here, which basically what that means is we'll look at what can we pull out of retirement funds to keep you in your current tax bracket or keep you from pushing you into another one, and weigh those sorts of things so that you know in retirement what that's doing from a tax implication standpoint. If people don't need their retirement assets, like their supplemental plans that Eva talked about, for example, for income, and maybe they just want to, they don't want to wait until they have to take money out until 72. They may want to proceed with Roth conversions early if they think taxes are going to be higher later down the road. So we help them with tax planning, again, having the accountants run those tax planners and then proceeding with those tax management strategies as an added layer to their investments.
Thank you. So we've got a kind of a follow-up on the beneficiaries question. If the beneficiaries, if someone passes and the beneficiaries are minors, do they still get the money or do they have to wait?
My understanding is they get the money. However, a guardian would have to be named by the courts if you do not have what's called a UTMA, or Uniform Transfer to Minors Act, where you've named a custodian on a beneficiary designation prior to that. Usually the guardian ends up being a parent, surviving parent. So when you're setting that up, if you have a minor, you may want to speak with your estate planning attorney about should I set up a custodian for this? And essentially what would happen is, if you have an 8-year-old child, for example, it would go into a trust that has to be used for their benefit, to be spent for their benefit, essentially, so that the beneficiary or parent or whomever would get it can't just go buy a new car with it.
Thanks,
but that's
Romney.
That's a lawyer question.
Lawyer question. Gotcha.
Yep.
Okay, what are the tax implications if I'm moving my pension to a Roth IRA? Can you talk a little bit about the concerns around that?
Yep, so that is going to be the same implication as if you were taking a distribution in the form of a lump sum, and rolling, when you do a conversion from a Roth IRA to from a traditional pension or a traditional IRA to a Roth IRA, it is a fully taxable event. And if you are under the age of 59 and a half, when you do that conversion, you want to have the assets, the savings outside of that conversion to pay for the taxes, because if you pay for the taxes or send the tax via a withholding from that IRA, it can be considered an early withdrawal penalty or 10% penalty. So I'd say before you do one of those, make sure you speak to someone just for the watch outs essentially. But it is doable and it is taxable.
Thanks, Romney. Okay, our next question is, how much do I contribute into the traditional pension plan? And does this, I'm just going to follow up, does this relate to whether I'm in the state teacher's retirement or whether I'm in the Ohio Public Employees Retirement System?
Yep. So when you, if you go onto the OU website and under retirement, there are two really nice charts that they have outlined each one of the individual plans and which one you opted into. And it tells you in there whether you are staff or faculty, how much you are contributing of your salary and how much OU is contributing to the pension. And same thing for the alternative retirement plan, it tells you the percentages in there, but they're different for staff and faculty.
Gotcha. It looks like Danette maybe just provided that link in the chat for you if you want to get right there. All right, guys, we've got about 5 minutes to the hour. Any other questions that we can answer for you? If not, thank you so much, everyone, for joining us. I will follow up with a copy of the recording as well as a survey so that you can let us know how we did today. We're always wanting to make these as valuable for you as we can. And I think we did have another question come in, so I don't want to miss that. Can we contribute to a retirement plan without it being payroll deducted? Like a supplemental retirement plan without it being payroll deducted.
The supplemental plans, the 403B and 457, the only way to deduct those is going to be through your payroll through Ohio University. If you want to contribute to a Roth IRA or a traditional IRA, that's going to come straight from your bank account. And you get to choose the amount and when, and you can do that in a lump sum once a year. You can do it on a monthly basis or anything in between or a combination thereof.
Okay, we've got another question. Can you talk about the differences between tax bracket and effective tax rate? How does one find that effective tax? I'm not sure if that's something you feel that you can handle, or if we would want to pass that along to maybe a tax individual.
Yeah, I'll give you an overview. Essentially, your tax bracket, when you say, well, what is my tax bracket? That's the highest tax bracket you touch. So if you say, I'm in the 22% tax bracket, some of that money you pay at the 10% tax bracket and so on, because it's progressive. We don't pay, just because you're in the 22% tax bracket doesn't mean you pay 22% on all of your taxes. Your effective tax rate is the average of all those progressive rates as you get to that highest one you pay.
Thank you.
Thanks, guys. Thanks, Eva, for all of this.
Yeah, thanks so much for coming. It looks like we're getting to some thank yous. We appreciate that you guys joined us today. And we will go ahead and close our meeting now, as it doesn't look like we have any additional questions. We will be sending out that follow-up email, so there's always the opportunity to reach back out to us if there's anything that we can help you with here.
Take care, everyone. Have a great day.
Thanks so much. Bye, guys.